A little information on stock signals can make trading easier and a lot more fruitful.
Don't try anything. I'm gonna kill myself, so don't try to stop me.
Here are the top 10 stock signals that you need to keep an eye on. Moving average, MA. The first trading indicator we're going to talk about is the moving average, MA, also known as the simple moving average, SMA. This indicator is used to identify the direction of a current price trend without taking into account the intervention of shorter-term price spikes. So, how does the moving average indicator work? It's quite simple. The MA indicator fuses the price point of a financial instrument over a specific time frame, and then divides it by the number of data points to give you a single trend. The length of your MA is dependent on the data you use. For instance, if you're doing an MA analysis for 300 days, you will need data for 300 days. The MA indicator helps you study price trends over a certain time frame. You can see levels of support and resistance while also getting a glimpse at the history of the market. All this information can help you determine future trends. Exponential moving average, EMA. The exponential moving average, EMA, is another form of the moving average. However, it's a bit different from the SMA. The EMA focuses more on recent data points, making data more responsive to recent information. When you combine EMA with other indicators, you can assess various market moves and figure out their legitimacy. For short-term averages, people mostly use 12 or 26 EMAs, while 50 and 200-day EMAs are more popular for long-term trend indicators. Stochastic oscillator. Another useful indicator is the stochastic oscillator. If you want to figure out if a market is overbought or oversold, then the stochastic oscillator is the indicator to use. This momentum indicator compares a specific closing price of a security with a range of its prices over a certain time frame. You can adjust the sensitivity of this oscillator to market movements by changing the time frame or by taking out the moving average of the result. If you get a reading below 20, it means that the market you're looking at is oversold. On the other hand, if you get a reading over 80, it means that the market is overbought. If the indicator finds a strong trend, you won't necessarily get a correction or a rally. Moving average convergence divergence, MACD. The moving average convergence divergence, or MACD for short, is an indicator that helps you detect the change in momentum by comparing two moving averages. This indicator can help you identify buying and selling opportunities around support and resistance levels. Convergence means that two moving averages are coming closer to each other, which means that the momentum is going down. On the other hand, divergence means that they're moving away from each other, meaning that the momentum is going up. The MACD is usually calculated by subtracting the 26-period EMA from the 12-period EMA. An MACD line is formed after the calculation is completed. Then, a single line is plotted on top of the MACD line. A 9-day EMA is referred to as the single line. Here's a little tip for first-timers. When the MACD crosses over the signal line, it's the perfect time to buy security. It's a great time to sell a security when the MACD crosses below the signal line. Bollinger Bands. The fifth indicator on our list is the Bollinger Band, which is a useful tool for predicting the long-term movements of a financial instrument. A Bollinger Band provides investors with a range within which the price of an asset typically trades. The width of the band increases and decreases to show the volatility of an asset. Bollinger Bands are defined by a set of trends plotted against two standard deviations above and below a simple moving average on the price. The narrower the bands, the closer the two bands are to each other. The lower the volatility of an asset. The further away the two bands, the higher the volatility. This indicator can help you assess whether the prices are relatively high or low. They provide you with a probability to help you identify whether an asset is oversold or overbought. When the price points are constantly moving outside the parameters of the band, it means that the asset is overbought. On the other hand, if they move below the lower parameter, it means the asset is oversold. Relative Strength Index, RSI. A super useful indicator to learn about is the Relative Strength Index, or the RSI for short. The Relative Strength Index is a momentum indicator that allows you to measure the magnitude of recent price changes to assess whether a stock or asset is overbought or oversold. You can avoid dangerous price movements with the help of the RSI. This indicator is displayed as an oscillator, which is a line graph that moves between two extremes. The RSI gives you readings between 0 to 100. If your asset is around 70, then it means it's overbought. If the RSI is near 30, then it means your asset or stock is oversold. An overbought signal indicates that short-term gains may be reaching a maturity level and that you might see a price correction. Alternatively, you could be in for a decline in maturity and assets may be in a rally if you get an oversold signal. Fibonacci retracement. In technical terms, the Fibonacci retracement levels are horizontal lines that reflect where support and resistance have a probability of appearing. As the name indicates, these lines are based on Fibonacci numbers. In simpler terms, the Fibonacci retracement helps you assess the degree to which a market will move against its current trend. A pullback of retracement refers to when a market experiences a temporary dip. The indicator can be used for any two significant price points and creates a level between the two selected points, which can be a high and low price point. For instance, if the price of a stock is originally $10, but then it drops to a low $2.36, in this situation, the Fibonacci numbers will be 23.6%. Usually, investors and traders use this indicator when they think a market might move against its trend. It helps them figure out where to apply stops and limits and whether to open or close their position. Ichimoku Cloud. Ichimoku is a Japanese term that translates to one-look equilibrium chart, which is exactly what the Ichimoku Cloud provides for investors. The Ichimoku Cloud is a collection of indicators that reflect support and resistance levels, which also are providing you with momentum and trend directions. It achieved this by taking multiple averages and plotting them on a chart. The Ichimoku Cloud has 5 lines, including a 9-period average, a 26-period average, an average of these 2 lines, a 52-period average, and a lagging closing price line. 2 of these lines form a cloud. This cloud predicts where future support or resistance of a price may be found. When the price is below the cloud, the trend is going down. In contrast, when the price is above the cloud, it's going up. Even though this indicator may seem more complicated than others, once you learn how to read it, you can easily understand well-defined trading signals. It's an important tool to help with decision-making. Standard deviation. If you studied statistics before, you may be familiar with the standard deviation. This indicator works in a similar fashion. It measures the dispersion of a data set in relation to its mean. In simple words, standard deviation helps investors assess the size of price moves. As a result, they can predict how this volatility may affect the prices in the future. Keep in mind that you can't predict whether the price will increase or decrease, only whether it'll be affected by the volatility or not. Generally, when the data points are further spread from the mean, you'll get a higher standard deviation. You can use it to compare current price movements with older price movements. A little tip. Many investors say that big price moves often follow small price moves, and small price moves follow big price moves. Try using standard deviation to see if this holds true. Average Directional Index, ADX. The last indicator on our list is the Average Directional Index, or ADX for short. This indicator reflects the strength of a price trend. Similar to RSI, it provides data on a scale of 0 to 100. If you get a reading greater than 25, it means you have a strong trend. In contrast, readings below 25 indicate a drift. This data is great to assess whether you'll see an upward or downward trend. The ADX is usually calculated using the moving average of the price over 14 days. Keep in mind that the ADX will not show you how a price trend will develop. It only shows you where the strength of a trend lies. If you see the ADX rise, it signals a strong downward trend, meaning the price is falling. If you're new to buying and selling stocks, then stock signals are extremely useful to learn about. Sometimes beginners dismiss the importance of these analytical tools and end up missing golden opportunities. The analysis tools may seem a little confusing at first, but with the right guidelines, you'll be able to learn about them in no time. How has your experience been with these stock signals? Let us know about your experience with stock signals in the comments below.